Welcome to a very exciting knowledge share presentation, and I've been looking forward to doing this presentation since I started this channel. And this is so a little bit of background that so I'd done a degree in economics and maths and a master's degree in risk, and I realised that inflation was something that I just needed to understand if I was going to invest and be successful in markets and things like that. And what your degree level subjects will teach you is that it's very Keynesian. So, or at least when I studied, it was very Keynesian. So they're basically saying that inflation is pretty much a function of aggregate demand in the economy. So if you want to cool inflation, you raise taxes, you raise interest rates, push demand down, and then inflation will come down. But what I've realized is that there's obviously a lot more to inflation than that, and we're talking money supply, currency debasement, and things like that. And this has made me think about different strategies to really hedge properly against inflation. Most people will choose bullion gold coins, and I know people that are quite decent size investors. They've got a lot of exposure to gold bullion, and they only ever buy things like sovereigns and 1 ounce gold Krugerrands or Britannias or Maples or something like that. And there's nothing really wrong with that strategy. If all you buy is bullion, there's nothing wrong with that. Bullion is is a very risk adverse way of investing in gold because the premiums are very low. So effectively what bullion will do is it will give you a performance that matches the gold spot price. And the obviously everyone is aware that as inflation goes on throughout the years, the gold price will just reset higher, reset higher, reset higher. And that's how you offset the inflation. But I'm going to make one or two very important points in this presentation. And I actually believe, I really believe that a lot of people viewing this will have not considered this before, and they will probably start to tweak their investment or their purchasing strategy when it comes to gold bullion. And this is why I started this channel, because I realized that there's a lot of people out there. Well, there's a couple of like well-known YouTubers that discuss gold, and they're very well respected, but all they do is talk about the same stuff. And you'll see a headline on their YouTube channel and you'll think, oh, this is going to be worth watching. And within like a minute, they're talking about the same old crap, just slagging off government, slagging off central banks. And I'm like, no, come on, give people some different viewpoints. And this is what I'm doing here. The reason why I don't believe that gold bullion is the perfect way of hedging against inflation is because gold has a diluted demand. And what this means is that let's say that I talk to some people, some of my friends or something that have got some money in the bank, and they listen to me and they're like, oh, okay, yeah, I'm worried about inflation. I should get gold. They don't have to actually buy physical gold bars or coins to have exposure to the gold market, because there's two things. There's unallocated gold and there's futures contracts as well. And what this does is it allows it basically dilutes the demand for gold, because if everyone who wants gold buys gold, there's only a finite amount of gold available around the world, like a pool of gold internationally that gets pulled out and then it gets sold back in and pulled out, sold back in. If everyone wants to buy gold, they have to compete for this pool. And during periods where demand is high, what you will see is that the premiums will just go up and up and up. But these two things here are what sort of gets in the way of that and caps the gold price. Because if I want to buy gold, or if someone else wants to buy gold, you can buy a certificate that says you own some gold, and it's unallocated, so there's no gold bar in a safe or a vault somewhere with your name on it and that's set aside for you. No, a company has just sold you a piece of paper that gives you gold price exposure. So if the gold price goes up, you can cash that in and you make profit as if you had a gold bar. It's like a proxy for a gold bar or an ounce of bullion. And the other thing is as well is that if you have a contract for difference trading account or one of these other trading accounts, spread betting accounts, excuse me, if you think that gold is going to go up, you can go long gold on the futures, and you can make money. You can make money as the gold price rises, so you have this exact same exposure as a gold investor, but you're not actually taking any of that physical gold out of the international gold pool, like the pool of available gold. So what this does is that it means that a lot of the demand for gold is satisfied fully without even touching physical gold. So when you look at the physical market and the supply and demand, so much of that demand is like satisfied without even impacting that physical market. And you've probably heard that futures markets are manipulation tools, but then someone once said futures markets are not there for manipulation. Futures markets are the manipulation because it is a substitute for owning physical gold. And this is why I believe that the gold spot price, and a lot of people believe this, the gold spot price does not fully show or reflect the true demand for gold bullion. And it's because of this, because there's other ways of getting the same exposure to the gold price, so you can make money as the gold price goes up without actually owning any physical gold.
Ornum is a precious metal bullion company based in central London. The company is known for sourcing very rare gold coins as well as their precious metal market reports, which are published on their website each week. Download the latest market report for free by visiting the Ornum website today.
Numismatic coins are very different to bullion because what they are worth does not depend on the gold spot price. What it depends on is the type of design, how rare that design is, or how rare that year is. Most of all, the condition. Because you can get what should be numismatic coins, but if they're in really bad condition, they will trade a lot more like bullion. So there are a few reasons as to why I believe that these are the true inflation hedges, and I'll just go through another example of what a numismatic coin is. And typically, what a numismatic coin would be is like a gold guinea, a 5 guinea, 2 guinea, escudos from Latin America, or a 1937 sovereign. For those of you that are not aware, there was a 1937 sovereign of George, King George, and these were only issued for like 1 year. They're 1 year types. They're very rare, especially in proof design. They can be worth a lot of money. So the reason why I believe that these will hedge against inflation better than the gold spot price or the bullion, gold bullion, is because I think that the value of these will change and be very sensitive to the money supply or the amount of money in people's pockets. So as money supply increases and it ends up in the pockets of investors and households, people that are able to invest, these coins, to get these coins, really you need to go to a coin auction. That it's not often you'll see these available at bullion dealers and things like that. So you have to outcompete other bidders. And the more money that's in people's pockets, the more they can bid for these coins. And this is why like you'll see people that will buy a coin for like 5 million. And you think to yourself, wow, why buy one coin for 5 million when you could buy a property and rent it out, and you can buy all sorts of things, stock portfolios. I think the reason why is because they sit on it and then they bring it up for auction in 2, 3 years' time. And they know that because the money supply is increasing, people have got more money in their pockets. They know that coin sold for 5 million previously. They've got more money now, so they know they're going to need to bid more than 5 million to get that coin. And it means a profit for the initial buyer. But these, I believe, are going to be more sensitive to the money supply, because it doesn't really matter what happens with the gold spot price. If the gold spot price is being manipulated by some of the bullion banks that work on reserve, work on behalf of the Federal Reserve, there's a lot of evidence to suggest that they do help to cap the price of gold. So if the gold price is being weighted on by that manipulation, but also the diluted demand, because not everyone that wants gold price exposure has to go into the physical market and affect the physical market, as I've mentioned. So it means that as you've got more money in your pocket, you can start to pay a higher price to secure these very rare coins. And that's why I believe that these are the true inflation hedges. Do I think that you should go out, sell all your bullion and start buying very rare 1 year designs and 17th century gold? No, I don't think that's the right thing to do. And as I will mention, there are a few downsides, and I just want to compare bullion and numismatic and come up with what I think is a good recommendation for the average investor. So we have the two choices. We have bullion and numismatic, and you don't need to sit on one side of the fence or the other. You can straddle the two. So you can be, and this is my recommendation. I would say most investors should be 75% bullion, 25 numismatic. And the good thing about bullion is that it's relatively risk adverse, because you know that you're paying low premium stuff, so you're paying a slight markup over the melt value of those coins. So if you see people that have been investing for years and they're paying 400 quid for a sovereign, and you pay 400 quid for a sovereign, your downside is the gold spot price. So as long as gold eventually goes up, you shouldn't make a loss on that at all. And this is very suitable for beginners because you don't need experience, and your portfolio will track the gold price very well. When we look at numismatic, this is more risk embracing, because you are paying very high premiums over the gold spot price of that coin, or the melt price of that coin, because it's rare and people want it, so it's worth a lot more than its intrinsic value. That means that there's research required. You can't just go out there and pay £10,000 or £30,000 for like some rare guinea, because these are quite liquid. You need to make sure that you're researching, and you need to make sure that you know roughly what that coin is worth, and that you don't overpay, basically, which is probably more of an art than a science. But as mentioned, the numismatic part of your portfolio should outperform bullion, because of how it's not so much related, or its performance is not so much related to the gold spot price, which we know doesn't fully reflect the demand for gold, and it's more sensitive to the amount of money that people have in their pockets. The amount of money that people have in their pockets is pretty much a function of the money supply. And that's my argument for suggesting that gold numismatic coins are going to be much better for hedging against inflation than standard bullion. So thank you. That concludes the video presentation. So this is a gold investment analysis channel, and I know quite a lot about the sector. So if there's something that you're not sure about, or you would like me to present, then comment in the section below. And if I get quite a few people wanting some sort of theme, then I will do a presentation on that. So thanks again for all your support on the channel, and I look forward to seeing you on the next one.